It's Wednesday, the 29th of September 2021. Welcome to Fear and Greed, the business podcast that sets you up for a successful day. I'm Michael Thompson, and good morning, Sean Aylmer.
Morning, Michael.
Shoppers desert the malls with the economy set to go backwards by 4% this quarter. That's our main story. Plenty on today. Australians set to do COVID tests at home, BHP under fire over its green credentials, and the competition watchdog takes aim at Google. Then stay listening for Sean's chat to Evan Lucas from Invest Smart about what's happening in the resources sector at the moment. First though, as I mentioned, Sean, shoppers have deserted the malls in Victoria, the ACT and New South Wales, with retail trade figures from the Bureau of Statistics showing a big slump last month. It's really not that surprising given the lockdowns, but just how bad was it?
Really bad, Michael. Turnover tumbled 1.7% in August, which probably wasn't as much as some economists had tipped, but the bottom really has fallen out of retail sales. They're now down 0.7% on a year ago. No surprises in any of this. Sales in New South Wales, Victoria and the ACT fell sharply. New South Wales is back to April 2020 levels. South Australia and Western Australia both performed really strongly. That's the good news. But sales have now fallen for 3 months in a row and could well do so again next month because we just don't know when shops are going to reopen. The hardest hit sectors last month were clothing, footwear and accessories, while department stores are really struggling. The big question is, how does all this feed into economic growth? And how much has the economy contracted during the current quarter, which of course finishes tomorrow? Retail sales are about 1/3 of total consumption, which feeds into economic growth. Now, according to AMP Capital Chief Economist Shane Oliver, a good friend of Fear and Greed, the economy is on track to go backwards at a 4% clip this quarter. The good news is that consumers remain pretty upbeat, with the latest weekly ANZ Roy Morgan Index showing that sentiment is still well above last year's lockdown levels, and certainly the vaccination rollout will only help that.
Yeah, and particularly when there's a clear roadmap for lifting restrictions, as New South Wales announced this week. So how did markets perform over the past 24 hours?
It was a dreadful day for the local market. The S&P ASX 200 fell 1.5% to 7,276 points. All the sectors struggled with the exception of energy stocks, and I'll come to those shortly. The healthcare sector had its worst day in more than a year. It's really underperformed recently, and healthcare stocks have been sold off on many major bourses around the world. CSL led the selling yesterday, falling nearly 4%. Sonic Healthcare was off 4%. ResMed and Cochlear both were down 3%. Technology stocks, they were also sold down. Xero was the worst performer in that sector, off more than 6%, while Appen and Megaport fell hard. The real estate stocks tumbled. The materials companies dropped. Fortescue Metals was off 5.6%. Notwithstanding, the price of iron ore looks to have stabilised. BHP was down more than 2%. Rio was off 3%. There was just red ink everywhere. There was some good news today though. Battery technology company LIS Energy listed and its share price jumped 175%. Not bad for a first day. It just shows how hot anything to do with batteries are at the moment.
Yeah, we spoke recently to the CEO of LIS Energy. It's a fascinating company. So what's happened on Wall Street overnight, Sean?
Well, Wall Street fell sharply also after both the Federal Reserve Chair Jerome Powell and Treasury Secretary Janet Yellen warned the US default due to a failure to raise the debt ceiling would have catastrophic consequences. President Joe Biden is trying to get the ceiling lifted by the deadline on Friday. In early afternoon trading, the tech-heavy Nasdaq was down 2.2%, the S&P 500 was off 1.5%, and the Dow Jones Industrial Average had dropped 1.2%. That's about the worst day's trading since last May. European markets were also sharply lower. In fact, there's a bit of discussion in markets over the idea of stagflation, that's higher inflation and slower economic growth. Not something any economy wants. The Aussie dollar is trading at just under 73 US cents and Brent crude has pushed above $80 a barrel for the first time in 3 years.
Now, we'll be back in a moment with the rest of the day's business news. But before we do that, Sean, some very exciting news.
Very exciting. We have a newsletter.
We do indeed. So head to fearandgreed.com.au to sign up. Get the latest news in your inbox first thing every morning. That's at fearandgreed.com.au. We'll be back in a moment. So, Sean, good news for anyone who's lined up to have a swab up their nose. Australians will be able to take a COVID-19 test from home after the federal government gave the green light to do-it-yourself kits from November 1. The rapid antigen tests give results in 20 minutes and are already used in the US and the UK. The downside is that they're not quite as accurate as current tests, but by the time the kits are available, 70% of the national population should be vaccinated.
Sure is good news. We need some of it at the moment with the case numbers still too high. Victoria recorded 867 COVID cases yesterday, the first time during the current wave that it's been higher than New South Wales. Actually, it revised the previous day's figure, so that was more than New South Wales too. Victoria's Health Minister Martin Foley said daily cases could reach almost 2,000 by late October. New South Wales yesterday reported 863 new cases and 7 deaths, with case numbers lower than expected, and hopefully the state won't see the spike next month that had been predicted by Premier Gladys Berejiklian just a few weeks ago. There were 13 cases in the ACT and 4 in Queensland, which triggered new rules around mask wearing for the Brisbane and Moreton Bay local government areas.
Yeah, not good news for Queensland. Now, BHP, one of the country's biggest carbon emitters, will take its plan to transition to renewable energy to shareholders at annual general meetings in London and Sydney over the next month because it's dual listed in both countries, for now at least. But one proxy advisor wants shareholders to vote against the Climate Transition Action Plan.
That's right. The next few months will be critical for the big mining companies and their efforts to decarbonise because it's AGM season. And increasingly, shareholders want to hear not just about targets, but how the big miners plan to decarbonise and hit those targets. This will only intensify in the run-up to the 26th United Nations Climate Conference in Glasgow in early November. Now, BHP has said that by 2030, the emissions it can control directly will be 30% lower than last year's level, and it will have net zero emissions by 2050, although it may have to rely on carbon offsets to actually achieve that goal. That plan is going to shareholders at their AGMs. At these AGMs now, proxy advisors are becoming more and more important, and one of the most influential is a crowd called Glass Lewis. Glass Lewis has advised against voting for the BHP plan, saying it doesn't have enough detail about how the big Australian will stick to the 2016 Paris Climate Accord, which aims to keep global temperature rises below 2 degrees Celsius.
So what happens then if shareholders do vote against the resolution?
Well, nothing immediately. A vote against won't necessarily scuttle the plan, but it will put enormous pressure on management to provide much more detail about how BHP plans to decarbonise. This is an issue for every single carbon-intensive company listed on a major exchange. Airports, resource stocks, energy companies. This will only get bigger in the next couple of years.
Yeah, not every carbon-intensive company's under the gun though. Whitehaven Coal's share price hit its highest level since 2019 yesterday.
Incredible story, Whitehaven Coal. It's Australia's biggest coal miner, and it's had quite a run recently as coal prices have soared and the company's been able to pay back huge licks of debt. It owed hundreds of millions of dollars 18 months ago, and there were real questions about whether it could keep operating. But coal prices have risen and it's been able to repay much of its debt. Its share price has almost doubled this year, and it's up 30% over the past 6 months. Now, thermal coal prices yesterday hit $180 per tonne, not far off the record price of $195 a tonne back in 2008. Why? Because demand from China and Europe has triggered a broad rally in energy commodities, and coal, gas and oil prices have risen really sharply. It's why Whitehaven has done so well recently, and why many of the oil and gas companies like Santos and Oil Search have done really, really well, including yesterday. Beach Energy yesterday was the best performer of the top 200 after saying it was planning to increase production of oil. Who would have thought that, given there's all this reticence about investing in fossil fuel companies? Without that, the share prices of these companies would be much, much higher. In fact, that's the topic of conversation in this morning's interview with Evan Lucas from InvestSmart.
Now, Sean, at the top of the show, I mentioned this pretty incredible story about Google. Now, the competition watchdog has called for new powers to rein in Google's dominance of the ad technology industry after it found that 90% of ad impressions online travel through a Google product. That's extraordinary.
Sure is. And Michael, you and I have been living this for many, many years. Yesterday, the Australian Competition and Consumer Commission, which has been looking into this for more than a year, said that it reckons Google's dominance has led to systemic competition concerns, and Rod Sims, the boss, said conduct that harms rivals. Essentially, Google has become the dominant player in online advertising, not just in terms of AdWords, but also providing the technology used to serve ads to websites and digital properties. It has its finger on 90% of ads that are online. Quite incredible, as you said. It means Google pretty much knows what's going on and can favour its own products over competitors if it chooses to do so. Treasurer Josh Frydenberg yesterday told The Australian that he will consider the ACCC report. It was important for regulatory frameworks to keep pace with changes being driven by digital platforms. We've already seen big technology companies take on the ACCC and their government, and they came to some sort of agreement last year with the media companies. Looks like we're going to do it all over again.
Sean, what's making headlines in today's news media?
The Financial Review is reporting that Woolworths is replacing a key measure of retail productivity when setting bonuses for managers. Instead, it wants to include a reputation score. The idea is that it will help rebuild trust in the supermarket, which has been plagued by wage underpayments. Also, the media is reporting this morning that the Morrison government will force state and territory leaders to abandon lockdowns, saying that $1.5 billion in emergency Commonwealth support for affected workers and businesses will be turned off 2 weeks after inoculation rates hit 80%. And finally, the Sydney Morning Herald is reporting that the New South Wales Nationals has backed new climate change targets to cut the state emissions in half by 2030.
Okay, running through some of the other stories around yesterday and this morning, the big battery fire in Victoria in July was caused by a cooling system leak, according to Victoria, the safety regulator. The Tesla battery fire was exacerbated by protective systems being turned off at the time. Certainly wouldn't help. It was the first major incident at a utility-scale battery in Australia, and there were fears it could derail the growth in batteries, though fortunately the regulator has given the all-clear for the unit to start operating again.
Michael, the boss of Domino's in Australia and New Zealand, Nick Knight, will step down. Mr. Knight used to deliver pizzas, and he ended up owning a store and rose through the ranks. His replacement, David Burness, has pretty much the same background. That's one of the things I love about Domino's and one of the factors in its incredible success. Many of the top executives, including CEO Don May, started as either delivery people or franchise owners. They know the business back to front, and that's really served the business well as it's grown.
Yeah, it's an amazing success story. And Don May actually spoke to you last year on Fear and Greed, and you can still find the interview on our website, fearandgreed.com.au. Well worth a listen, that one.
Michael, I just got to say, some of the cross-promotion in today's episode has been excellent. I think we've got 3 mentions so far.
It's pretty impressive, isn't it? And don't forget, head to fearandgreed.com.au and sign up for the newsletter as well.
Oh, beautiful. Off you go.
Tell
me about listed investment companies, would you?
I will. The consolidation of the listed investment company sector in Australia continues. WAM Capital, run by Jeff Wilson, a recent guest on Fear and Greed.
Number 5.
Has bid for PM Capital's Asian Opportunities LIC. Asian Opportunities is already under offer, though, from another listed investment company.
Yeah, I don't think any other sector has more corporate takeovers going on at the moment than that sector, and that's saying something. And finally, a new report says that in 2019, Sydney Airport reported 967,000 tonnes of carbon emissions, but the real figure was closer to 7 million tonnes. If the whole of the journey is included, not just the takeoff and landing, that is a lot more than coal-fired power stations produce.
Now, Sean, what's the key overseas news this morning?
Bloomberg's COVID resilience ranking is released every month, came out last night, and Ireland has become the best place in the world to live, at least in terms of COVID, followed by Norway. New Zealand and Singapore have tumbled down the list. Australia comes in at number 35 of 53. And I'm not sure that this is a key overseas news story, but TikTok now has more than 1 billion active users just 4 years after its launch. School closures and telecommuting has been a boon for the video sharing app. From my point of view, it's also introduced my children to a whole genre of 80s and 90s music they would never have otherwise heard.
Sean, do you think Fear and Greed should end up on TikTok?
Perhaps. No, Michael, no.
I think I'll work on you. We'll get there eventually. Now, up next is the Daily Interview, and we've mentioned this one a couple of times already this morning, but it's a very timely chat with Evan Lucas, the head of strategy at InvestSmart, trying to make sense of the resources sector.
It's great. We talk about iron ore, we talk about gold, about coal, about the battery metals. He really does run through the whole gamut of that part of the economy.
And that's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you very much, Sean.
Have a great day, Michael.
It's Wednesday, the 29th of September, 2021. Make sure you followed Fear and Greed on LinkedIn, Twitter and Facebook. You can find more info and sign up for our newsletter at fearandgreed.com.au. I'm Michael Thompson, and that was Fear and Greed. Have a great day.